So I believe over the years of my experience that doing global macro requires three things. It requires a framework. And for us at TPW Advisory, the framework is the tripolar world. It requires a structure. And for us, the structure is what we call our global risk nexus, a policy I developed 7 years ago covering climate, economics, politics, policy, and markets in each of the three regions and globally. And it requires a process. Otherwise, you get distracted by the latest shiny thing or the dumpster fire, etc. The process at TPW Advisory is one I learned decades ago at Morgan Stanley. We write every week, pretty much without fail, every week. Our Friday musings, our monthlies, all available on Substack. And we offer model portfolio delivery service with a global multi-asset model and a TPW 20 thematic model. And so we're vertically integrated. We go from research at the coalface through the process of writing into implications for model portfolio development. So today what I want to talk about is what I call the long game. And that was the title of our monthly we put out 2 or 3 weeks ago, Play the Long Game, and really look at 2025 through 2030 and the global growth long cycle that we have been talking about for some time now. So going back to my comments just a second ago, AI, climate, and defense, all existential, all three regions of the tripolar world, spending aggressively to compete in those areas. That is underpinning and driving a global growth long cycle that we think began back post-COVID and is extending, we think, into 2026, 2027, and beyond. All of this is being driven by what we call the new industrial policy, the fusing of public and private, fiscal and monetary policy. It's an all-hands-on-deck approach, which China really took the lead in with the renewable energy area, and now dominates that space. So this is a competition to compete in the highlands of the global economy. And China has mastered this new industrial policy better than any other region, better than any other country. And it's now taking that lead in renewables and extending it into advanced manufacturing and beyond into AI. Trump obviously is an accelerant, we believe, to the tripolar world thesis. He himself is driving, his administration driving European spending on defense and also ceding the renewable energy space to China as the Trump administration cuts renewable funding in the United States. And so it's all about, in our view, who has the fiscal space, right? The US led post-COVID for two reasons. It stimulated much more aggressively than any other major economy and enjoyed significant labor force growth. Those two things drove US growth to be better than the rest of the world in the 2022 to 2024 period. That better growth led to better corporate earnings, led to higher multiple expansion, led to massive inflows. And as we can see in our first chart, these massive inflows are significant. $2 trillion went into US assets in the last several years from abroad. Okay, and all that led to the highest multiples that the world has. Now, importantly, and to George's point, the US no longer has any fiscal space. The whole focus of the Trump administration is on tax cuts, something we've been arguing for months. And we talked and wrote a piece called Stoic Strategy, saying pay no attention to the Trump team or administration, no attention to anything they said, because it can all be changed at the next press conference. So tariffs and DOGE were meant to make space for the tax cuts in Trump 2.0. Both have failed, and so now we are confronted with massive new deficits, obviously going to have implications for interest rates, for the dollar, for stocks, etc. And so as we can see in our second chart, The point here is that the US no longer has fiscal space to operate. And therefore, the opportunity set is migrating to countries that do have fiscal space. Countries like Germany, for example, with 63% debt to GDP. Countries like China, similarly, central government debt in the 60% range to GDP. So in our view, the US equity bull market and US Treasury bond market, both a product of fiscal utilization, are now migrating from the US to the rest of the world, to Europe, to Japan, to emerging markets. And thus, it's no surprise to us that non-US equities are leading. No surprise to us that the bond bear market, especially in duration, has gone global. Makes perfect sense. The markets are sniffing out that governments are going to spend aggressively. Therefore, rates are going higher. And in the interim, sadly, the US is going backward under President Trump, while Europe and Asia accelerate forward. So as we can see in chart 3, with the renewables, while China aggressively invests in renewables and pushes forward into advanced manufacturing, the US is canceling renewable funding. The AP put out a comment yesterday, 14 billion, updated number, 14 billion of renewable energy projects in the United States have either been canceled or delayed year to date. So when we think about renewables, it's not just renewables, not just EVs, right? You think about batteries going into robotics. Look at all the success Ukraine has had with drones. What's the key driver for drones? Batteries. So it goes from EVs to robotics to advanced manufacturing. So the next 5 years, we think, are going to be pretty difficult for the United States. Trump is a chaos agent, admittedly so, and yet the US financial assets are priced at a premium. Those two things do not go together. And so when we look at what's going forward, we see a United States, as we see actually in chart 4, a United States that's got lots of problems, right? Government is cutting renewable energy, freezing immigration, pushing out international students, cutting funding for science and innovation. None of this is constructive for global leadership. And so the key point for us and for you who are listening, if there's one thing you take away from my comments, is that we believe we are at the beginning of a secular leadership change in global equities, away from the United States, which has been the sole leader of global equities from the bottom in 2009, so for 15 plus years. That equity leadership is migrating away from the United States to the rest of the world. And we expect this leadership change to be underpinned and supported by a long period of capital repatriation and reallocation out of the United States. That $2 trillion we showed back in slide 1, much of that is going to find its way back home or to other parts of the world over the next several years. And this is happening, you know, kind of as we speak. If you pay attention to these factors, one of the reasons why we don't pay attention to what Trump says is it's an investing superpower to allow you to spend your time and focus on what matters, which is understanding what's going on in Germany, understanding what's going on in Japan, in China, in Brazil, in Indonesia, etc. And that's where we focus our attention. And so as we see in chart 5, it's really interesting to think about what's the right weight for the US in ACWI, right? It peaked at about 70% or so, as this chart shows. Now it's in the mid 60s. Look at where it bottomed in 2009. 41% of the global equity marketplace was the US in 2009, 41%. Now, I'm not going to say that I think it's going to go back there, but would I be surprised in 2028, 2029 to see the US at 50% of ACWI? No, I wouldn't be. And I don't think you should be either. So for us, this is really important. We are already seeing signs of countries encouraging verbally, and in some cases mandating legally, that their local pension funds and insurance companies purchase more domestic assets, invest more at home, right? We're talking all this talk about trade and tariffs, focus on capital. And it's one of the things that really makes no sense to us about the US policy approach. The US is the world's biggest debtor. It's the most dependent on foreign capital, and yet it's being the most aggressive in pushing that foreign capital away. It makes absolutely no sense. And it's one of the things you realize is that many of the players driving economic policy in the Trump administration are fringe players, guys who were on the edge of what was considered reasonable to contemplate. And those fringe players have now moved to the center of policymaking. And that helps explain why the policy is so out of whack with arguably what should be done. And so we have read just in the last week, couple weeks, Canada, China, the UK in the last week, telling their domestic institutions they need to own more domestic assets, need to fund the AI, climate, and defense build out in their own countries. So we expect much more of this in the years ahead. The US is talking about taxing US Treasury positions. Again, talk about a fringe idea. I mean, it's just absolutely naive and dangerous. So what do we want to do? Coming to the close of my comments here, and talking specifically about the markets. We have written for the last month or so and continue to believe we want to sell US equity rips and buy non-US equity dips. We want to be overweight equities in a global multi-asset portfolio. We want to be overweight non-US equity versus the United States. ACWI just hit a new all-time high this week. ACWI-X, similarly. EWJ, Japan, new all-time high this past week. We really like emerging market equities and debt. We think EM has the biggest upside, 25 to 30% just to get EEM back to all-time highs. So as we look at chart 6 and consider this point, this is a key point, okay? Typically, in crises, the US is the fireman. The US rescues the situation. Today, the US is the arsonist. And therefore, what typically happens in crises is that the dollar strengthens and other currencies weaken. That puts policymakers, particularly monetary policymakers, in a bind. They can't cut to support their economies. In this case, it's the opposite. The dollar is weakening because the problem is in the United States. Therefore, EM currencies are strengthening, providing room for their central banks to cut rates and support their economies. Just in the last week, South Africa, South Korea, and Mexico have all cut rates. Currencies are perfectly fine. So we really think a big winner here is going to be in the emerging markets. Considering fixed income, very underweight in our global multi-asset model. We have been zero weighted in US Treasuries for the last 3 years, even though fixed income represents 40% of our benchmark. Treasuries are in the longest bear market in history, going on 5 years of bear market activity. We like credit, particularly EM credit, both dollar and, no surprise given my comments a minute ago, local currency. But where's the real opportunity? And I'm stealing probably a little bit of Tavi's thunder here because I know he agrees with this. The real opportunity is in commodities right now, right? Stocks have run, particularly non-US. Bonds are unattractive. Commodities have done nothing for years relative to equities. and are big winners in a fiscal stimulus-driven global economic long cycle. Big winners, okay? So we are double weighted in our models in commodities. There we go. As chart 7 would suggest, showing gold miners here. Gold miners are up 50%. And look at that chart. I mean, it's pretty amazing, right? So we are double weighted and across the spectrum. Precious metals, GDX, for example, copper miners. Today, George, copper just broke out over $5 just for this conference, right? Making the point. Copper miners, nuclear power, ag, energy, the whole thing. Europe is stimulating. Asia is stimulating. The US wants to run hot. Commodities are priced in dollars. Dollars are weakening. It's a really, really attractive setup for the commodity space, in our opinion. And finally, to finish on the thematic side, really keen on renewables, renewable energy. The penny has finally dropped among some people that in this long cycle, in this 2025 to 2030 period, there's only one solution to the need for power to drive AI, which is existential, and that is renewable energy. Can't build a nuclear power plant in 5 years. And if you want to do natural gas, go ahead and order a turbine from Siemens or from GE. They'll tell you that if you order a turbine today, it will be available in 2030. So the real opportunity set right here, if you believe in AI, if you believe in the whole drive for electricity, for power, renewable energy is your ticket to happiness. All right, George, floor's all yours, buddy.
Wow. Just wow, Jake. You really bring it, you put it, tie it all together. And again, in the theme of this conference, you make it actionable. It's just not like an endless sports talk radio, blah, 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 with no conclusion. Okay, so let's dig in, Jay. I don't know where to begin, but let me give it a shot. So again, Dorothy, we're not in Kansas anymore. This is not the post-GFC environment. Let's start with bonds, because if I were to try to like be the loyal opposition and say, okay, Jay, you're too bullish, I think you would have to go something along the lines of, given that there is no austerity in the U.S., and as someone said to me the other day, Doge, D-O-G-E, is dead, D-E-A-D. It's kind of like an Animal House. Niedermeyer, dead, okay? Doge, dead, okay? Doge was never a thing, all right? So we don't have austerity, and as you rightly point out, we have fiscal impetus now coming from other parts of the world, be it the release of the debt brake in Europe or what's going on in Asia. And you're not calling for a recession. There was a question here, don't worry, Jay. So I would actually be more concerned about, is it possible that, one of the surprises might be, Byron Ween, please call your office, so he's not with us anymore, that interest rates, bond yields go up more quickly and more greatly, that's a Trumpism, more than markets expect. And by the way, sidebar, none of Jay's comments are intended politically. We're here just to try to, what are the financial implications of what's being said and done? So no political suicide here at all. We're just trying to make money out of this. We're trying to avoid losing money. So with the lack of austerity domestically and fiscal expansion now at the margin occurring internationally, what are the odds that bond yields go up more than people imagine? And without getting too Weimarish, let's just say, the 10 years, 5.5 or 5.25 or something like that. It doesn't have to be about inflation either. Everyone say, well, Jay, I looked at true inflation numbers and they're really low. No, it's just about supply and demand for capital and term premium. Michael Howell will be in here later, and real rates. And you plug in. So what are the odds that rates go up like that? And then B, when and how and will other risk assets care?
Yeah, that's exactly the right question, George. And we wrote about this last week in our title, Run Hot or Not, with the idea being that I think the administration has given up on the revenue generation, as we talked about, right? Those 2 trillion ended up being 50 billion or less, right? Tariffs were going to generate all this money, you know, making really no progress there. We're supposedly going to do 90 deals in 90 days. I think we're up toward close to 60 days with 0 deals. And so the team has decided that we're going to have to run hot. That's the language coming out of Besant and others in the administration. And so run hot is all about driving nominal GDP growth, right? So not just the real GDP growth, but real plus inflation. And this was really key post-COVID. One of the things that kept us out of the recession camp, and again, we write every week, so we're in print. You can go back and look at what we wrote about 3 or 4 years ago. The nominal GDP, understanding that earnings are reported in nominal dollars, and nominal GDP growth in post-COVID was running at 6, 8, 10%. No way were we going to have a recession, and no way were stocks going to go down when earnings growth is double digits. And lo and behold, it didn't. So today, you have a situation where some folks have scored this out. Nominal GDP growth is around 6%, needs to be around 6.5% to keep the debt level flat. Okay? Currently, nominal GDP is running at about 4.5%. So there's a 2% gap, 2 percentage points gap between where nominal GDP is going to have to run to keep the debt level flat versus GDP versus where it is today. And so I think the whole issue is, where do the buyers come from? Who is going to buy the debt? And there's an answer to that, and it is the banks, right? The whole point here is we're going to see regulatory change that's going to allow the banks, US banks, domestic banks, to take on more treasury ownership. And that is going to keep rates stable. And so that deals with a little bit with the idea of capital repatriation and US debt becoming less attractive, right? That's the other side of it, is that now if you're a foreign buyer of treasuries, you have to hedge the currency, right? Before, last couple of years, no currency hedge, just naked, because the dollar was appreciating against your currency. And you made, you know, your yield plus currency appreciation. Now that's flipped. So if you're a Japanese insurance company, Japan being the country with the largest, you know, net international investment position, positive position, right now it's completely uneconomic for you to buy treasuries versus just simply buying JGBs. Yield differences have shrunk, and the currency hedging costs have exploded. So it's just not economic at all. So you have to find new buyers for the treasuries to stabilize the debt, to stabilize the rate environment, so we don't have a blowout like you suggested, which is indeed possible without those new buyers. So we're watching that regulatory frame. I forget, I'm sure one of the other folks know it off the top of their heads. I forget what the term is, but there are going to be regulatory changes which will allow the banks, US banks, to buy more treasuries, which will protect against that blowout treasury risk that you talked about, which if it were to happen, I agree, would be a problem. Last point I just want to mention is because it's really, again, very important. And George, you know this really well. Back in the day when you and I used to talk regularly when you were at Fidelity and I was at Morgan, the best environment for non-US equity outperformance is when the US is just kind of muddling along, right? When the S&P is up 20%, no one gives a hoot about non-US. When the markets dive, typically non-US dives even further. And that was one of the big tells of April. Markets had a massive pullback, and yet non-US outperformed. They were leading going in, and they sustained their leadership coming out. That is a massive tell, in my view, about who has the strength, right? Who's got the juice? Who's got the energy? It's clearly not the US. US is still trying to get back to all-time highs set last February. Rest of the world is breaking out to new all-time highs. If the US was to catch up, that's the laggard, that's a good sign. But the real important point, if US is going to run hot, nominal GDP is going to be 6%. Let's tack on earnings. Let's say earnings, therefore, are going to be 5 to 10%. Perfect environment for the US equity market to just muddle along. Let time take care of that excess premium valuation, which is no longer warranted under a Trump administration. And the rest of the world can continue to lead.
Wow, Jay. Get into EM just a little bit. It's a very heterogeneous group of countries. Back in the day, very heavily commodity laden, not so much anymore. But clearly, China is different from Latin America, which is different from Eastern Europe. Are there any comments, high level or low level, that you'd like to make about particular areas that you like?
Sure. Yeah, I mean, your point about makeup is completely right. If you look at, if you look at EEM today, and I know there are better, cheaper vehicles, but I'm old school, so that's the one I grew up with. That's the one I look at. When you look at EEM today, the three biggest countries, I think, are China, Taiwan, and South Korea. Main commodity folks are way, way low at the bottom. If you look at what's traditionally been considered a major EM commodity play like Brazil, guess what the number one holding of EWZ is? It's Nubank.
What? Wait, no.
Yes.
It had to be, I bet my life it had to be Petrobras of Valley. What is Nubank,
George,
Jay? Jay, what is Nubank?
Pro tip, don't bet your life, George.
What is Nubank?
Ever. Don't ever bet your life.
Is that some Brazilian crypto thing? Like, what is that, Jay?
No, it's a fintech, and this is one of Brazil's great exports, right? Because they have to deal with hyperinflation, their financial system is very, very highly evolved, right? Because when you have thousands and thousands of percent of inflation, movement of capital and money, even a couple of days, a day or two makes a big difference. So anyway, Nubank is a fintech, very active in the Brazilian financial system, and literally is the number one holding of EWZ. It's got about a 15% weight, I believe. So just emblematic of your point that,
wow.
Today's EM is not like your old, not like the EM when George and I were young, which was very different. So look, I've got as many thoughts as you've got time for. I know we've got time for other questions, so I'm going to make it quick. We like China. We like China a lot. We are positioned in large caps and in tech, right? We've been in K-Web for plus a couple of years now. Look, the US and China are walling each other's tech stack off. This is where the tripolar world framework really comes in handy, because we spend a lot of time thinking about Asia. We spend a lot of time thinking about Europe. It's not new to us. We're not all of a sudden have to try and figure out what's going on there. We know what's going on there because we've been looking at it for years. So tech stack being walled off, splinternet, as we called it for the last several years, means that you can own China tech to participate in that tech ecosystem and big cap US tech to participate in that ecosystem. And we do. We own both. So we really like China. We think the real estate crisis there is bottoming. We think stocks going up are going to help stimulate consumer confidence. I mean, look, US consumers have benefited from decade plus bull market in housing and in stocks. China, it's been the opposite. So once that confidence level returns a little bit in China, we think there's a lot of upside there. And by the way, the other reason why we love China is because the government's made it abundantly clear they are not going to let the market go down. So to us, the risk reward is extremely attractive, very low risk and considerably high reward. So China sells at like 10 times earnings, George. US is at 21 times earnings, okay? The other region we like, we've got several places. We like Poland in Eastern Europe. So again, tripolar world. So we have China representing Asia. We have Poland representing Europe. Poland just had an election, didn't quite go the way folks thought it would. Markets handled it like a champ. And what we're really interested in right now is Latin America. And Latin America is a big winner in terms of dollar. When dollar weakens, LatAm does well. It's one of the charts we showed just a few minutes ago. And we think Brazil is, we talked about Mexico cutting rates, supporting their economy. And we think Brazil is at the beginning of a rate cutting cycle, just finishing rate hike cycle. Real rates in Brazil, George, 9%. Real rates,
What?
9%.
What? 9%? What's with that, Jay?
Well, it's a legacy of hyperinflation. And so today it's not hyperinflation in Brazil. Inflation's like 5%. But 3-month government paper, the Selic rate annualized is 14.5%, 14.25, 14.5. So 9% real. So we think Brazil is about to begin a rate cutting cycle that will be quite supportive for its economy. And in the interim, it's a big winner from China deciding to buy ag away from the U.S. So forget about buying U.S. soybeans, buy Brazilian soybeans. Forget about buying U.S. chicken, buy Brazilian chicken. And so we're really quite keen on LATAM. So EM, big weighting. We also like EM debt, as I mentioned, local currency and U.S. dollar. Local currency, rates being cut, local currency debt should appreciate. And the U.S. dollar debt, no problem, because those currencies are strengthening against the dollar, not weakening.
So Jay, I can't remember if you wrote it or somebody else wrote it a few months ago. R is for rotation, not recession.
Yeah, no, that wasn't me.
No, it wasn't you. But you think we're going to be
Like the
seeing
title, though.
You know, all right. You know what? I'm allowing you to go with it because I don't know where it came from. Anonymous, okay.
Yeah.
So it's not you're not tinfoil hat, get out of the U.S. because we're going to zero, any of that kind of stuff. It's just that you think there are better opportunities elsewhere. So is it, if I got you correctly? So a few questions from the audience. Any concerns, just all about China? One is, are you concerned at all about possible prohibitions on the trading or ownership of Chinese stocks in the U.S.?
You know, that's something that a lot of people trot out, right? I mean, that's kind of like a DEFCON 3. I think things would have to get really, really bad between China and the U.S. to do that. Remember, the U.S. is the most dependent on foreign capital of any major economy. And if the U.S. decides to start doing things like that, that's kind of beside taxing U.S. Treasury holders, right? In my view, both things are extremely dangerous and would do real damage to the United States and its ability to access capital from abroad, which is required. If you start doing that type of stuff, I think you watch U.S. rates skyrocket, the dollar crack, and got lots of problems. You know, China tech exposure, ADR exposure, KWEB exposure is not going to be the major problem if that in fact happens, in my opinion. So it's a risk, yes. It's a risk we think we at least are willing to take. We think the upside is significant. China tech, the ecosystem in China is much bigger than the United States tech ecosystem or e-commerce system. It's growing much faster. And the big winners in China tech are trading at anywhere from 40 to 60% discount to their U.S. peers. So there's a lot of risk already priced in.
So just building on that, Jay, there's 2 or 3 questions here, all kind of circling around the same issue. Any recommendations for emerging market ETFs? How do you own China and Brazil? Best way ETFs, et cetera, et cetera. So for someone at home, a viewer, what are a few of the ETF? I mean, you mentioned KWEB, it's probably FXI. There's EWZ, EPOL for Poland.
George, you got them all, buddy.
There you go. Okay, I thought so.
You got
I
them
thought
all.
so. I
Okay, but
thought so.
you got to let me give a little commercial.
All right, go, 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 go,
All right,
go. Hey,
commercial time.
and Jay.
Okay, so the
Tell folks,
solution.
tell folks. Wait. Gotta set you up here. So, if people, because you have your own Substack, and they should find you on Substack. It's tremendous value. Tell folks as part of your service, what do they get if they subscribe to your Substack, Jay?
Yeah, well, the Substack is part of it, which is the writing. So you get that weekly or weekly Friday musings, typically 1,500 words or so about the markets, which we think is really useful to keep us forward focused. We're big believers at focusing forward. I think time and space is shrinking. Things are moving much faster. The speed of decision making, speed of market discounting is accelerating. So we want to be at the front end of things. We want to be constantly kind of surfing the wave, and writing weekly really forces us to do that. So the bulk of the Substack benefits are attached to the writing. Really don't get the writing without becoming a paid subscriber. I really don't give much away on the free side, to be perfectly honest.
But there
The
are
other side, sorry,
Yep.
just to finish, the other thing that we do is we do offer a model portfolio delivery service. And so if you're looking to build a global multi-asset model, you have to, all you have to do is reach out and come to TPW Advisory, and we can provide you with that model, which we update every month. So it's not aggressively trading. Roughly 25 to 30 positions in that global multi-asset model, benchmarked 50% to ACWI, 40% to Barclays Ag, 10% to Goldman Sachs Commodity Index. So that's the benchmark. We aim to beat that benchmark. As I said earlier, we're overweight equities, vastly underweight fixed income, and double weighted commodities, to give you a sense of our current positioning. Roughly 30 ETFs. That service comes with a monthly call with me to discuss the model and changes in markets, and is something that I think people are becoming more interested in, simply because it's been global since we started it, which was now 4 or 5 years ago. And so again, we have a long history of participating in these markets. So if you're interested in understanding how to build and develop a global multi-asset model to participate in the world that we think is unfolding over the next 5 years, reach out.
Jay, that's fantastic. I listen to you speak. I joke with folks that, hey, the last umpteen years, international diversification, like, who needs it? Is that a thing? Like, if I can make or lose money between 9:30 a.m. and 4 p.m. Eastern time, why do I have to be up early in the morning to watch Europe or late at night to watch Japan? But the times, they are changing, and sort of in similar fashion, Jay, and you're old enough to remember when, being a Japanese analyst was a thing. All right. But it became so out of fashion. There are very few folks, look at your Rolodex, very few folks around who have institutional memory back to 89 and what that was like prior to that. They are survivors. Okay. I affectionately would say you are a survivor. Like, who really cares about emerging markets? All right. I mean, but so I think your time has come. You're spinning the wheel. And things go in cycles. And again, not to shamelessly promote you, but let's be real about this. 99% of what you see in financial research, it's pretty much domestically oriented. It's all about Mag 7. I mean, NVIDIA, I think, is still bigger than the entire energy sector or something crazy like that. So everyone's staring at their navel thinking, oh, should I be underweight NVIDIA, overweight Amazon, this, that, and everything else? Where you're painting a picture of a brave new world where the game's completely changed. And you gotta be looking outside the Mag 7. It's not the Mag 7 are terrible. It's just let's say, for the sake of the argument, they're flat or they go up 5 or 10% or whatever. At the same time, dollar could go down at least that much. And so let's just say in Mag 7, in yen terms, actually there is a question I'm going to put to you. In Mag 7, in yen terms or in Swiss franc terms, if you're sitting in Tokyo or sitting in Europe, you're losing money. And maybe you could just go back a little bit more on those capital flows, because you and I spoke a few weeks ago about how Your guesstimate, I think, from Stephen Lee Jen was, I don't know, 25 trillion or some ungodly number of money had flown into the U.S. over the last decade or two. And just explain for a domestic investor who really hasn't been paid to worry about currencies, how now the tide has shifted, what it's like through the lens of a European or Asian domiciled investor sitting there looking at your Mag 7 or your S&P and why that could be problematic for flows.
Yeah, exactly. Before we get to that, George, just one point on the cycle. As we talked about, the U.S. has led global equities since the bottom in 2009. That's 15, 16 years of U.S. equity leadership. So what we're talking about is not a quarter, not a couple of quarters, not even a year, right? What we're talking about is a secular, not cyclical, secular change in leadership that can last 5 years, 7 years, who knows how long. The last time non-US outperformed US was after the tech bust, the dot-com bust, right up until the great financial crisis. So for about 7 years, non-US outperformed. And we wrote a piece a couple weeks ago titled "Old Timers Wanted," because remember the old adage, right? In the hedge fund space with the bull market, right? Bull market, get a kid, right? And put the kid in charge of the portfolio, because the kid has no memory, has never lost money, and therefore it's just going to do what you're supposed to do in a bull market, which is just buy, right? That was the saying back in the day. So we inverted that a little bit and said old timers wanted, because we think the non-US are outperforming and will continue, most importantly, to outperform for a considerable period ahead. And the only people who remember what that looks like are old timers. You have a whole generation of people grow up never investing in a period when non-US equities outperformed. And the currency is key here, right? Yeah. Because as you talk about, Japanese investors, somebody did the work not too long ago. Year to date through the end of May, if you're a yen-based investor and you own the S&P, you're down about 8%. Right? If you're a euro-based investor, you're down 7, 8, 9%. If you're invested in the US equity market unhedged, which most time equity guys are unhedged. And therefore, that's the difference. Whereas in your own market, let's say if you're a German-based investor, like Allianz or something, right? And you're overweight the US because that's been the place to be, and you've been massively outperforming your domestic benchmark, and you've been promoted 5 times, and you're an MD at Allianz. Now your U.S. equity position is down close to double digits, and your domestic equity market is up 30%. 30% in euros. So, I mean, the action, the flip is intense. As I said, that's going to drive these capital repatriation. It's going to feed on itself.
100%. Jay,
on itself.
Yeah, Jay, I have to add. So I'm pretty active on X and social media, and
really,
yeah, and I post something like, "Well, gee, still stay long gold," or buy a foreign stock that the party's just begun. And the takes I get, the responses I get, "Oh, dude, you're late. Europe's had the biggest outperformance ever, since the beginning of time, blah, blah, blah." Or gold, "Oh my God, you're late," And I just think back, it's so funny how we're all prisoner to our own biases. I mean, for how many years have we been hearing? And I think maybe it was Jim Cramer, I don't remember who it was, who said, don't trade Apple, just own it, right? Okay. So here it is. EM, you look at the relative charts, been going down forever. You can't find, the blip, you can't even see at the bottom of the chart, right? And people are saying, "Oh, it's over." And okay. And you've been pointing out, when you see movements like that, no, that's like first inning. That's like bottom of the first inning. Okay, the party is just getting started. And so I just think there's such a bias. And this, Jay, from talking to clients, and I'll use social media as a substitute for client interaction. You can judge a lot by the pushback you get. People bring you heat, they don't care, or then they're telling you, "No, Jay, you're not bullish enough on emerging markets. You know, when it's selling on 40 times
I haven't heard
earnings.
that
Okay,
one yet.
haven't heard that one yet. Okay, but you have the wrong way Louis clients who remain in the federal witness protection programs who remain nameless, right? So you know how to read certain clients, so you know where you are on the cycle. So I venture to say, I say this as a friend, and it probably bodes well for your Substack and your business. A year ago, who needs Jay Pelosky? What the hell? Dude, I'm good. I got Mag 7. Just want to know if you're for Apple or Nvidia, right? Now the game has changed. And I'm just curious, last question, it's kind of a nebulous question, but you know, in your travels to deal with clients or whatever, because this speaks to positioning as well. So it doesn't matter what you or I think, what the narratives think, and the fundamentals think. One thing we haven't really spoken about here is positioning, but I think it's implicit in your remarks. People are really not prepared for this, no? I mean, they're out of position.
Yeah, I mean, I would think that's right. I mean, you see different things, kind of suggesting different different outcomes. But I go back to that U.S. weight in equity, right? I think that's the cleanest way to think about it, right? Peaked at 70%, never been higher. Now it's in the mid 60s, bottomed back in 09 at 41%. So, I mean, I just think that when you look at it, as you said, the Mag 7 have a bigger market cap than most other countries, most other regions, bigger than many, many things. And so that just is not right. And so the U.S., as I said, the whole thing for us is really simple. What drove U.S. outperformance post-COVID? Fiscal stimulus, labor force growth, period. Period. That's it. Led to better economic growth, which led to better earnings, which led to higher multiples, which led to capital inflows, led to stronger dollar. It's all reversing. It's all now happening elsewhere. It's now happening in Europe the next couple of years, in Asia next couple of years, in LATAM next couple of years, where growth is going to be better, earnings are going to be better, multiples are severely depressed, as we talked about, right? EM trades are like 11 times earnings. 11 times earnings. Japan is like 13 times earnings, and it's breaking out to new all-time highs. EWJ, just punch up the chart.
Jay, those numbers do not compute. I'm used to 11 times revenues or 13 times revenues looking at domestic equities.
Sure.
Craziness.
And some of the Mag 7 deserve it because their earnings growth, like NVIDIA,
right.
Look, earnings growth is even better, so it's cheaper than it's been in many years, and that's fine. So we own some of that. Don't get us wrong. We own the semiconductor space in a reasonably well-sized position because we believe in the AI age. We also own renewables because AI needs power. We own copper because there's a lot of copper that's going to be used. So we own the electrical grid system. We own the whole space. We want to own all the way through that. And so to us, it's really it is time to keep your eyes open, understand the game has changed, position elsewhere, buy dips, as I said, right? We want to sell U.S. equity rips because we think the upside is capped. And we want to buy non-U.S. dips because we think the upside is just beginning. And as I said, these moves last for years. So we are in the very early innings, in our view. And we do expect further further dollar weakness to provide that tailwind, along with repositioning. Both repositioning in terms of U.S. investors going abroad, as well as offshore investors going home, as well as, particularly in places like Japan, where investors domestically have been in fixed income, switching out of fixed income where they're losing money and buying equities. So there's a lot of reallocation, not just from one country to the next, but even inside countries that has yet to take place.
Final question, Jay. It's brilliant. Final question from the chat. Are you at all concerned about China's one-child policy in terms of the outlook for Chinese equities and their economy?
Not at all, because China's, building the robotics of the future, right? Building humanoid robotics, and that is going to be the workforce of the future in the factories within China. That's why the whole idea of the U.S. bringing manufacturing jobs back And, as Secretary Lutnick said, somehow thought this was exciting to people. There's going to be lots and lots of Americans having jobs screwing tiny little parts into iPhones. That doesn't exist. That's robots are doing that and will do it going forward. So no, what we want to do is we want to participate in China because China is taking the lead that they generated in the new industrial policy in renewables, and they're advancing that into robotics and therefore further into advanced manufacturing. And really, actually, I didn't say this before, but let me say it now. China is fusing AI and renewable power. They're the first major economy to get the fusing of AI and renewable power. And that is big time competition for a US which, yes, has leadership in AI, but is nowhere in terms of power. And for Europe, similarly, not where they need to be in AI, not where they need to be in renewables. And so this is, again, the competition in the tripolar world of Europe, Asia, and the Americas that is driving the spending, that fuels the global growth long cycle, that provides the earnings for the global equity bull market and sets the conditions for a global bond bear market, which we think is the kind of the landscape for the next 3 to 5 years.
Jay, I can't thank you enough. You and I were talking about you wanted to be the keynote guy. You said the leadoff hitter, and I said don't bunt. You said don't worry. But man, you swung for the fences, and oh my God, did you connect? I just can't thank you. This has been fabulous. And again, if you want to hear more from Jay, and I strongly urge you, everyone, I read his stuff, please check him out on Substack. He's also on X. But Jay, I can't thank you. This business is fabulous, and I also think you're right. All right.
There you go. There you go. That's most important.
All right, Jay.
Thank you. Thanks for having me. Good luck with the rest of the conference. Been exciting to be a part of it. Really appreciate it.
Thanks so much, Jay. Take care. Thank you.